Welcome to speedearning.com. Today we shall discuss about inflation. What is inflation? Actually, inflation means upward movement in price of commodities, general prices of commodities. Suppose essential commodities are going upside in their prices, then this rise will be calculated as inflation, and inflation rate is calculated for better financial planning. So there is one CPI. What is CPI? Consumer Price Index. Consumer Price Index is calculated with the weighted average of 200 essential commodities. You can Google search the list of 200 essential commodities, so you can see the list thoroughly, which are the things which are involved in essential commodities. And the second thing is WPI, Wholesale Price Index, average price of the commodities which are traded in bulk. Some commodities are traded in bulk by the wholesale dealers, and that denotes the wholesale price index. So inflation rate is calculated on the basis of these two indices, and inflation rate is declared by the government agencies every week. So inflation rate is declared there. You just focus on that. It reduces your purchasing power. Suppose inflation rate is going higher, then your purchasing power of your money is going lower side. Suppose you have 1 lakh rupees and there is an inflation rate of 5% 1 year, 5% in last year. So what will happen? Your purchasing power is reduced to 95,000 only. So if you are saving your money and taking the returns, but if you are not calculating about the inflation rate, then your financial plan will be out of use, because your money is increasing to double in 8 to 9 years, and suppose inflation rate is increasing faster than that, and your money will grow up to 2 lakh in next 9 or 10 years, and the inflation will go up from 1 lakh to 4 lakh. So your purchasing power will reduce to 50% only. Means you are on the same place where you were before 10 years, because 1 lakh is equal to 2 lakh after 10 years. That's why for right financial planning, you should calculate the inflation, consider the inflation rate, and your rate of return should be higher than inflation rate to beat the time. Because if you are not beating the inflation rate, you won't be able to pay for your children's school fee, you won't be able to pay for buying a home, you won't be able to pay for hospitalization, even you will feel the difficulty for your day-to-day grocery bills. That's why we are telling you, suppose you are having some seeds in your hand, so isn't it important that where are you planting those seeds? If all the land are same for you, then it's not true. You will have to sow your seeds in fertile lands, wherever you are getting the return more than inflation, and according to that your allocation should be to different asset classes. There are many asset classes we have already discussed in our total financial planning or total money management discussions. So FDs are there, fixed return instruments are there, insurance is also there, real estate is also there, gold and silver, precious metals is also there, equity and mutual funds are also there. So You need to learn the right allocation, and that is different for different age groups. So you need to learn all those things in detail to become a really rich person. Thank you very much. Bye.